Welcome back to the Deep Dive, the place where we convert stacks of financial documents and complex research into the focused insights you need. Today, we are immersing ourselves in the fascinating world of quantum computing, specifically analyzing the Q3 2025 earnings report for Rigetti Computing, ticker symbol RGTI.
Right, RGTI. They're right at that intersection, aren't they? Cutting-edge physics meeting high-stakes finance.
Exactly. And the market's trying to judge them on, traditional metrics like quarterly revenue, but they're really a moonshot R&D company. So our mission today is to filter out the noise, especially those kind of misleading headline numbers, and use our sources to figure out the 3 or 4 things that actually matter for their long-term survival and, well, success.
And that tension is really the core narrative here, isn't it? When you analyze a company whose main product, viable, fault-tolerant quantum computation, might still be years away, well, the traditional scorecard isn't much use. For Rigetti, the financial headline is almost always secondary to, execution on the tech roadmap and, critically, the health of the balance sheet. They're building a whole new industry, not just optimizing an existing one.
That requires a completely different way of looking at it, then.
It really does. A different analytical lens. We need to integrate their internal progress with how the external market's reacting to get the true picture.
Absolutely. The market is impatient, but physics. Well, physics takes time. Let's start by looking at the basic numbers they delivered. We'll begin with the at-a-glance scorecard. Okay, so if we just look at the headlines, Rigetti's quarter was a bit of an exercise in financial contradiction. A classic mixed bag, really.
Yeah, a mixed picture is a good way to put it. They beat on the operational bottom line, the adjusted EPS, but they had a clear miss on that all-important top-line revenue.
Let's nail down those specifics, because the market reactions seem to hinge entirely on these 2 points.
Okay. So Rigetti reported total revenues of $1.947 million. Now, the analysts, the street consensus, they were looking for $2.17 million.
So, a definite miss there.
A definite miss, and that immediately raises investor eyebrows, right? For a company valued on future growth, revenue is sort of the proxy for commercial traction. Are customers buying? Is the market adopting the tech? This number suggests, well, adoption is maybe slower than expected.
But then there's the other side of the coin, their cost control.
Exactly. If you look there, the picture brightens up a bit. Their non-GAAP, or adjusted earnings per share, came in as a loss of just 3 cents, $10.03.
And the expectation was?
The consensus expected a larger loss, $2.04 per share. So this was a win. A slight beat, but still important. It signals better than expected operational efficiency, disciplined spending.
Okay, so better operations, tighter ship, but worse sales than hoped for. What did the market choose to focus on? We saw the stock trade immediately after the release. That was Monday, November 10th, 2025.
And the verdict was pretty swift and negative.
It dropped.
It did. Despite that operational beat, the stock dropped 2.57% in extended trading. And that negative movement tells us exactly what the priority is for investors right now. They're prioritizing the revenue miss, that perceived lack of commercial traction over the improved cost control.
Which is typical for its kind of company,
Yeah.
development stage.
Very typical for a development stage tech company, especially in high growth spaces. Viability, which is demonstrated by revenue growth, even small amounts, usually trumps mere efficiency, which is the EPS beat. They want proof the product works and sells, not just proof management can, save money.
Viability over efficiency. That distinction is crucial. Okay, but now we have to tackle the number that probably scared off the most casual observers. Let's look at that summary table comparing the quarters. Total revenue down 18.1% year over year.
Which is that commercial weakness we just talked about.
Right, but then you look at the GAAP net loss. This is where the number gets, well, terrifying.
Yeah, it jumps off the page.
The GAAP net loss exploded to nearly 255%. Specifically, $200.968 million. That's just a staggering figure. A loss of over 1,255% from Q3 2024.
An incredible percentage jump.
If I'm just a casual investor, seeing a $2 million revenue company lose $200 million in a single quarter, I'm thinking the company's just vaporizing cash.
Yeah.
How is this not a catastrophic operational failure?
It really does look like that on the surface. It's the kind of headline that makes you panic, but honestly, it's purely an accounting technicality. A big one, but still technical.
Okay.
We have to understand the difference between GAAP, generally accepted accounting principles, and the non-GAAP figures they also report. And specifically, we need to talk about something called derivative warrant liabilities.
Okay, before you dive into the warrants, maybe I can give a quick definition for our listeners about the EPS measures we use.
Good idea.
When we talk about EPS, we often contrast basic versus diluted. Basic EPS is pretty straightforward, just the net income divided by the common shares outstanding. Simple enough. Diluted EPS, though, is what analysts usually prefer for a more conservative view. It assumes that all those potential convertible securities, things like stock options, restricted stock units, and importantly here, warrants have already been converted into common shares.
So it shows how much the earnings would be sort of diluted across a potentially larger pool of ownership down the line.
Exactly. It gives you the worst case scenario for ownership dilution.
And that emphasis on convertible securities, particularly warrants, is absolutely key to understanding this $201 million mystery loss. Rigetti had raised a lot of capital previously by issuing warrants.
Which give the holder the right to buy stock at a set price later on.
Precisely. A warrant gives the holder the right, but not the obligation, to buy the stock at a fixed price, the strike price, in the future. Now, because Rigetti's stock price has actually performed so well over the past year, it rose dramatically leading into this report, the potential value of those outstanding warrants increased dramatically too.
Right, let's try an analogy maybe. Make it a bit more concrete.
Okay, sure. Think of it like this. Imagine Rigetti sold you a contract, a warrant, allowing you to buy one share of their company for, say, $5 tomorrow. If the stock is currently trading at $10 today,
then that contract is worth $5 to me right now.
Exactly. That $5 difference is effectively a liability on Rigetti's books because they have this obligation to give you that share for $5 less than its current market price, should you choose to exercise the warrant.
Okay.
Now, let's say the stock price jumps to $20. Suddenly, that same contract you hold is worth $15 to you. $20 market price, $5 strike price.
So Rigetti's liability just increased by another $10 on paper.
Precisely. Even though no cash has changed hands yet, the company's liability just increased by $10. Accounting rules, specifically GAAP, require them to revalue this potential future obligation every single quarter based on the current market conditions.
And because the stock soared?
Because the stock soared, the paper value of the liability associated with all those outstanding warrants increased by a massive $181.95502 million this quarter. This forces them to record that gigantic non-cash loss on the income statement.
Wow, so it's the ultimate irony, really. The stock doing well causes a huge paper loss under GAAP rules.
It really is. The paper loss doesn't reflect an empty bank account or a failed product launch or anything operational. It reflects the potential future dilution from those warrants and the increased value of those options they granted earlier. It's a liability that might turn into cash for the company later, if exercised, but for accounting purposes right now, it just screams disaster on the GAAP statement.
Which is exactly why analysts immediately strip that charge out, right?
Exactly right. When you remove that non-cash charge, and a couple of others we'll get to, the non-GAAP net loss tells the real operational story. And remember, that figure improved by 20.7% year over year to $10.652 million.
Okay, so that improvement confirms the operational efficiency we saw in the EPS beat earlier.
It does. But we learned our first major lesson of the quarter. The market still saw the revenue miss as more important than this operational win, despite the GAAP noise.
So we've established that the operational loss of about $10.7 million is the actual cash-based expense we should be tracking. Let's follow that operational story now and see what drove their performance behind the scenes. Let's move beyond the GAAP smoke and mirrors. Time for the engine of profitability. All right, so we know the GAAP and non-GAAP net losses differed by a huge amount, roughly $190.3 million. We've identified the massive warrant charge as the main culprit, but let's maybe break down the rest of that reconciliation for clarity. We need to know what else management chose to exclude when showing us their adjusted operational performance.
Absolutely. Understanding these exclusions is vital because it reveals management's view of what counts as core business spending versus, non-cash or non-recurring items.
So the big one we already covered.
Yeah, the first and by far the largest item they added back to get to that non-GAAP number was the $181.955 million charge for the change in fair value of derivative warrant liabilities. That's the stock price-driven paper loss we just dissected.
Okay, what else?
The second non-cash item, much smaller but similar in nature, was $4.062 million for the change in fair value of earn-out liabilities.
Earn-out liabilities. That sounds like acquisition-related stuff.
Usually, yes. These are often tied to potential future share payments, maybe stemming from a past acquisition, where the payment is contingent on hitting certain performance targets. And often it's paid out in stock, not cash. So again, it's a paper adjustment based on valuation changes, not actual cash going out the door this quarter.
Right. And the third major item, the one you see in almost every high-growth tech company's reconciliation.
Stock-based compensation. You got it.
Yeah.
They added back $4.299 million for stock-based comp. Now, this is a legitimate expense of doing business, especially for attracting top talent in a super competitive field like quantum.
But crucially for measuring their financial runway.
It's not cash leaving the bank account today. It's shares being issued, future dilution being used essentially as currency to pay employees. So when you combine those three main non-cash items, the warrants, the earnouts, and the stock comp, you get back to that non-GAAP net loss of $10.652 million.
Which is our truest proxy for how much cash their actual operations burned through this quarter.
Exactly.
Okay, that makes the operational loss picture much clearer. Now let's pivot to the margin analysis, because this detail seems to throw a bit of a wrench into the idea of just pure operational health. We saw a concerning trend declining gross margin, quite substantially actually.
Yeah, this is definitely something to dig into.
Let's look at the numbers again. In Q3 2025, Rigetti reported $404,000 in gross profit on that $1.947 million in revenue. That works out to a gross margin of 20.8%.
Okay.
But compare that to Q3 2024, they had $1.204 million in gross profit on $2.378 million in revenue, giving a gross margin of 50.6%.
Wow, it's a big drop from over 50% down to just over 20%.
Yeah, that's not just the dip. That looks like a significant structural shift in how much profit they make per dollar of sales. What could be driving that?
That is a major red flag, you're right. It requires some interpretation because when a gross margin collapses like that, it suggests a pretty fundamental change in the economics of their sales or delivery. There are a few possibilities, and they probably intertwine.
Okay, like what?
Well, possibility number one, the mix of revenue shifted. Maybe it moved entirely toward lower margin services. Early quantum revenue often comes from things like consulting, installation, maybe managed services contracts.
Which have high labor costs, right? High cost of revenue.
Exactly. So if Q3 2024 revenue included maybe the sale of some higher margin initial hardware or perhaps licensing fees, and Q3 2025 revenue was predominantly these lower margin services or maybe bespoke R&D work for a client, the overall margin would naturally drop sharply.
Okay, that's one possibility. What else?
Possibility number two, the actual cost to produce or deliver their existing services just spiked upwards. Their cost of revenue for Q3 2025 was $1.543 million. Did they suddenly face, unanticipated price increases for critical components like their cryoelectronics?
Or maybe issues at their fabrication facility?
Could be. Did they have utilization problems in their fab, meaning the fixed costs were spread over fewer output units or projects? Management didn't explicitly break this down in the release, but the sheer steepness of that margin drop from 50% to 20% suggests either the new contracts they secured this quarter were far less profitable than whatever drove revenue last year, or they hit a significant operational hurdle in their manufacturing or delivery process.
That's critical context. So they might be generating some revenue, but if it's very low margin volume, doesn't really help them get to self-sustainability any faster.
Correct. It slows that journey down.
Now, let's pair that margin analysis with their spending strategy. Their overall loss from operations actually widened slightly to $20.549 million. But maybe the most important number in this whole section is how they are choosing to spend their money, given the revenue and margin pressures.
Yes, the strategic allocation.
Despite the revenue dip, despite the margin squeeze, Rigetti actually increased its commitment to the future. Research and development expenses. They rose 17.8% year over year, climbed from $12.752 million last year to $15.02 million in Q3 2025.
And this is the key strategic signal of the quarter, I think. And it's a bold one. They're facing clear market disappointment on the commercial front, right? The revenue miss, the stock drop.
Yeah.
But management's response is not to immediately slash costs to try and appease the market with better short-term numbers. Their response is to allocate even more capital to R&D.
So we have this picture. Falling revenue, shrinking gross margins, and yet rising R&D spending. They seem to be deliberately prioritizing future technical milestones over fixing the short-term financial performance.
That's exactly what it looks like.
What allows them to make such a, almost anti-market decision right now?
It comes down to one thing, the balance sheet. This deliberate, aggressive investment in the future is only possible because they have an enormous financial safety net. They are essentially telling Wall Street, look, we hear your concerns about this quarter's revenue, but we are playing a game measured in years, maybe even a decade, not quarters. And we have the cash reserves to ensure we can play the long game and win.
Which brings us perfectly to what might be the most crucial section of this entire deep dive.
The money.
Let's transition right there. We are now going to look at financial strength and shareholder rewards. Slide 4. Okay, for any pre-profit, deep technology company like Rigetti, the really critical question isn't, did they make money this quarter? We already know the answer to that is no.
Right, that's a given for now.
The real question is, how long can they keep operating, keep funding that R&D without having to go back to the market, cap in hand, asking for more capital? And the balance sheet gives us the definitive answer.
And the answer here is, well, it's pretty impressive.
Yeah.
Especially when you consider the high-risk, capital-intensive nature of the quantum industry.
Let's look at their liquidity position as of September 30, 2025, the end of the quarter.
Okay. They reported a healthy cash and cash equivalents balance right on hand of $26.133 million. But that's just the pocket money, really. The vast majority of their war chest is held in liquid investments.
Available for sale investments.
Exactly. We're talking a substantial $420.850 million classified as short-term available for sale investments. And on top of that, an additional $111.955 million in long-term available for sale investment.
Okay, let me add that up. 26 plus 421 plus 112. That gives us a total liquidity position of $558.9 million sitting there at the end of Q3. That is a massive number for a company this size.
It is. And incredibly, the number actually grew even bigger after the quarter officially closed.
How?
Thanks to the other side of that warrant story we spent so much time on earlier. Remember that huge paper liability caused by the stock price going up?
Yeah, the non-cash loss.
Well, post-quarter, many of those warrant holders decided to actually exercise their right to buy the stock, which means they sent cash to Rigetti to buy those shares at the agreed-upon strike price.
Ah, so the liability converts into actual cash inflow for the company.
Precisely. The company reported receiving an additional $46.5 million in cash from those warrant exercises between the end of the quarter and November 6th.
So if we add that $46.5 million to the $558.9 million at quarter end.
It brings their total pro forma liquidity to approximately $600.9 million as of early November. So that's stock price appreciation didn't just cause a confusing paper loss, it directly funded the balance sheet with tens of millions of dollars more.
$600 million in liquidity. Okay, now let's do the crucial calculation for the listener, the financial runway. We need to compare that $600 million war chest against how much cash they're actually burning through.
Right, the burn rate.
Our sources tell us that the net cash used in operating activities, so this is the cash burned just running the business, separate from investing or financing for the first 9 months of 2025, was $43.642 million.
Okay, let's slow that down for the audience. That $43.6 million covers 3 quarters of spending, right? Q1, Q2, and Q3 of 2025.
Correct.
So to find their average quarterly operational burn rate, we just divide that 9-month total by 3. 43.6 divided by 3. That gives us a figure of approximately $14.55 million per quarter.
$14.5 million per quarter.
Yep. That $14.55 million is their essential oxygen, you could say. It's the cash required every 90 days or so to keep their R&D efforts humming and the lights on.
Okay, so now we have the 2 key numbers. $600 million in total liquidity, divided by a $14.55 million quarterly burn rate. This calculation provides, I think, the single most reassuring number in this entire report.
It really does. $600 million divided by $14.55 million per quarter. Rigetti has a financial runway of approximately 41 quarters.
41 quarters, that translates to over 10 years.
Over 10 years of operational life, assuming their burn rate stays roughly consistent.
Wow. Over a decade of guaranteed existence, basically. In the quantum computing landscape, where breakthrough technology is notoriously difficult and timelines seem to stretch almost indefinitely, a decade is practically an eternity.
It absolutely is. I'd argue it is the single most compelling data point in their entire story right now. This massive runway is the strategic advantage that allows them to effectively ignore the short-term market angst about quarterly revenue misses.
It means they don't have to take desperate low-margin contracts just to hit some arbitrary quarterly target Wall Street set.
Exactly. They can afford to keep investing that $15 million a quarter, or even more, into R&D. They can focus exclusively on the high-reward foundational technology that might take years to fully mature without the constant looming threat of needing to raise more capital in potentially unfavorable market conditions. They are insulated.
Insulated from nearly every market pressure and economic cycle for the foreseeable future?
Pretty much. That's the power of that balance sheet.
And that puts their capital raising efforts earlier this year into sharp focus, doesn't it? They weren't raising cash back then because they were desperate.
No, quite the opposite. They were raising capital strategically, opportunistically to build this very moat, this decade-long runway. They are clearly not in a capital return phase, yet there was no mention of dividends or share repurchases. All the focus was on building this war chest.
Looking back at the first 9 months of 2025, the report shows they raised capital through two main avenues. First, a huge chunk, $346.7 million, was raised through something called at-the-market offerings, or ATMs.
Right. For listeners unfamiliar, an ATM offering is essentially a sophisticated way for a publicly traded company like Rigetti to sell new shares incrementally directly into the open market at whatever the prevailing market prices are at that time.
So instead of one big, potentially disruptive stock offering.
Exactly. Instead of announcing one massive secondary offering that might cause the share price to tank, they can sort of drip feed shares into the market over days, weeks, or months. It allows them to raise capital more quietly and efficiently, often leveraging periods when the stock price is already strong. It's a very flexible fundraising tool.
Okay. And the second mechanism they use?
They also raised $35.0 million from a Quanta private placement transaction.
Private placement, meaning not sold to the general public.
Correct. A private placement means they sold shares or possibly other securities directly to a limited number of sophisticated institutional investors in this case, an entity named Quanta, rather than through the public market. It's often quicker than a public offering, but might involve offering a slightly larger discount to entice that institutional buyer.
So between the ATM and the private placement?
That's how they built the roughly $600 million war chest that now defines their entire long-term strategy. They successfully monetized the market's confidence in their future potential earlier in the year to literally buy themselves a decade of R&D time.
Okay, we've covered the financial reality, the mixed quarter, the Jap noise, the incredible runway. Now, let's see what management is promising to do with all that time and money. They clearly needed to shift the conversation away from the Q3 revenue miss and firmly onto the future technological path.
Absolutely. Pivot to the roadmap.
We turn now to the road ahead management's outlook and key takeaways. This corresponds to slide 5 in our analysis.
Right. And the CEO, Dr. Subodh Kulkarni, was very clear in his narrative on the earnings call and in the press release. The focus was all on execution and momentum. He specifically emphasized demand, particularly for on-premises quantum computers, which is an interesting niche.
He highlighted their development collaborations as well.
Yes, stressing the importance of those partnerships. The core message was very much, don't worry about the quarterly blip. The long-term vision is intact, and we're making progress.
Okay, and on the near-term technology front, how are they tracking? Did they update on their goals for this year, 2025?
They did. The sources confirmed they are still aiming to deliver their critical 100-plus qubit system, which is based on their chiplet architecture, by the end of this year, 2025.
And it's not just the qubit count that matters here, right? It's the quality.
Precisely. Qubit count is the easy thing to advertise, but fidelity, the accuracy and reliability of the operations, is arguably much more important for actually doing useful computations. They anticipate achieving 99.5% median 2-qubit gate fidelity with this upcoming system.
Hitting 99.5%, that would be a pretty major technical milestone, wouldn't it?
Oh, absolutely. It would be significant validation that the aggressive R&D spending we saw them ramp up in Section 2 is being deployed effectively and yielding real hardware improvements.
And their ambitions clearly don't stop there. Supported by that immense cash runway we just discussed, they laid out a new and frankly highly aggressive long-term technology roadmap. This seems designed to capture the attention of investors who are focused on that long-term future value.
It really does. The roadmap establishes a clear trajectory for scaling both qubit count and performance, meaning fidelity, over the next few years. For 2026, the goal is to deploy a 150-plus qubit system.
Okay, an incremental step up in count.
Yes, but importantly, also aiming for an even higher fidelity.
Yeah.
99.7% median 2-qubit gate fidelity. So it shows this plan for continuous planned iteration and improvement.
But the really ambitious goal, the one that probably got the most attention, is set for 2027.
That's the big one. For 2027, they plan to deploy a massive 1,000-plus qubit system.
1,000 qubits.
1,000 plus, and targeting yet another step up in quality, aiming for 99.8% median 2-qubit gate fidelity.
That 1,000 plus qubit marker, that feels like a real threshold in the quantum race, doesn't it?
It really is seen as kind of the next major milestone for many companies in the field. That scale, combined with high fidelity, is generally considered what's needed to start attempting commercially relevant calculations that might actually outperform classical supercomputers in certain specific application areas.
So by setting that 2027 deadline,
Management is providing a clear, concrete, 3-year goal for how they intend to spend a good chunk of that $600 million war chest. This is the company basically saying, this is our primary technical objective for the medium term. It's their commitment.
and crucially, they tried to show this isn't just a fantasy roadmap disconnected from reality. They also highlighted some concrete progress in their commercial pipeline, which helps validate the technological direction with, actual customer money or commitments.
That's important, yes. They announced securing approximately $5.7 million in new purchase orders for 2 of their smaller 9-qubit Novera systems. Those are expected for delivery sometime in 2026.
Oh, okay, so still selling the current generation hardware.
Exactly. It shows the commercial side, while maybe slower than hoped, is still functioning and generating orders. Furthermore, and perhaps more significantly from a validation perspective, they secured a substantial contract, roughly $5.8 million over 3 years from the AFRL.
AFRL Air Force Research Laboratory.
That's the one. And this contract is specifically focused on advancing quantum networking capabilities. When a major government research arm like the AFRL commits millions of dollars over multiple years to fund your R&D efforts, well, that's a powerful external validation. It signals that they believe Rigetti's technology has long-term strategic relevance.
Okay, so if we add those up,
Yeah.
the $5.7 million for the Novera systems and the $5.8 million AFRL contract, that's about $11.5 million in new business or secured R&D funding.
Right. Around $11.5 million in future business or funding that directly supports the continued execution of this technology roadmap. Even though that revenue hasn't necessarily hit this particular quarter's numbers yet,
Yeah.
it shows the pipeline isn't dry, it's still building.
Okay, the picture seems pretty complete now. We have the context of the mixed quarter, the accounting noise, the massive cash pile, the spending strategy, the technology goals, and some validation points.
Yeah, I think we've covered the key angles.
So let's try and synthesize this entire deep dive into maybe the 4 essential takeaways that every listener really needs to carry forward from this Q3 report.
Okay, let's summarize. Takeaway number 1. The quarter itself was undeniably mixed. Revenue missed expectations, coming in at $1.947 million, confirming slower near-term commercial adoption. That's likely why the stock dipped.
Wow.
But the operational EPS loss of just call R3 actually beat expectations, signaling good cost control and efficiency. And the market, at least initially, prioritized that viability concern from the revenue miss over the efficiency demonstrated by the EPS beat.
Okay, takeaway 1. Mixed quarter revenue miss weighed more heavily. Takeaway 2.
Takeaway 2. That headline GAAP loss of nearly $201 million is almost completely meaningless noise for understanding the business operations. It was driven almost entirely by non-cash paper accounting related to the stock performing well, which increased the derivative warrant liability on paper.
Right. Don't get spooked by the GAAP number.
Exactly. The true financial measure of the quarter's operating performance was the non-GAAP net loss of just $10.7 million, which actually showed improvement year over year.
Got it. Takeaway 3 feels like the big one.
It is. Third, and this is arguably the most enduring part of the story right now, the financial runway is the company's strongest strategic asset. That approximately $600 million cash and liquid investment position gives them over 10 years of operational insulation at their current burn rate.
10 years.
This completely changes their strategic calculus. It allows them to be patient, to be aggressive with R&D, and to weather market storms.
Okay. And the 4th and final takeaway.
Fourth, management is explicitly shifting the focus to the future. They are investing heavily. We saw that in the rising R&D spend to hit that ambitious 2027 roadmap goal of a 1,000-plus qubit high-fidelity system. And this forward-looking strategy is getting some validation, evidenced by that $11.5 million in new contracts and government funding announced alongside the earnings.
Okay, that brings us to the final narrative then. This quarter really showed a company facing the harsh realities of early-stage commercialization in a very difficult and nascent market. That led to the revenue miss that spooked investors initially. But the story underneath that, it's one of exceptional long-term financial planning and strategic patience.
Indeed. The market, understandably perhaps, fixated on the quarter's specific revenue number. But for a technology as foundational, as complex, and as long-dated as quantum computing, that $600 million war chest, that 10-year runway, is frankly the only number that truly matters right now.
Hmm.
It is the golden ticket. It's what allows them to chase that ambitious 2027 1,000 qubit goal without the constant quarter-to-quarter pressure of having to demonstrate immediate profitability or explosive revenue growth. They've bought themselves time.
And this brings us, I think, to a final provocative thought for you, the listener, to take away from this.
Our structured approach today, moving through the scorecard, the profitability engine, the balance sheet, the outlook, it moves you past just the scary headlines and the sort of mechanical definitions.
Hopefully, yeah.
We learned that for a development stage company, especially in a capital-intensive sector like quantum, knowing the cash runway is often the single most important piece of information you can have. It can far outweigh the significance of a single quarterly revenue variance.
So the ability to look past GAAP, isolate those non-cash charges, calculate a realistic burn rate, and compare it against the available liquidity.
That process, which is a repeatable method you can apply to many high-growth pre-profit companies, is really the key to unlocking the true strategic health and long-term viability. It helps you understand if they actually have the resources to achieve their ambitious goals. That knowledge is your power as an analyst or investor.
Thank you for joining us for this deep dive into Rigetti Computing's Q3 2025 results. Before we go, please note the following mandatory disclaimers. Financial disclaimer. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure the accuracy of the information, no guarantee is provided.
And also, the AI disclaimer. This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.